2021 has been the year of severe weather conditions, stockpiling, and supply chain disruptions, which saw commodity prices positioning themselves as one of the best performing assets of the year. But with inflation continuing to hit record highs in 2022, many question what the performance of this asset group will look like this year. To answer some of these questions, I am joined once again by Nitesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree. Nitesh, welcome back to the podcast. I want to start quickly by winding back to last time you were here and just take up a few points, because that time you were talking about how gold had been underwhelming in its inflationary hedging purposes. But in WisdomTree's monthly report for the month of January, you talk about the overall hedging abilities of commodities. Could you elaborate on that? What are the commodities that have stood out for you in 2021 as having those specific hedging purposes with inflation?
Well, Daniela, thank you very much for inviting me back to your podcast. Yeah, you're right. 2021 was the year for commodities after over a decade of commodities underperforming. In fact, we saw commodities' best market performance in over 20 years, so since the year 2000. Onto your point on inflation hedging, yes, 2021 was a year of elevated inflation. If you look at inflation surprise indices, they were running at record highs on the global level. And gold, which many view as a strong inflation hedge, didn't quite perform to the standards expected, with gold prices having fallen. But if you look at commodities in a broad sense, so looking across industrial, energy, agriculture, combining them together, they provided an excellent inflation hedge. And it kind of goes down to some of the reasons that were driving inflation during 2021. Lots of the inflation that came into play was very much of a surprise nature. There were supply side shocks. You talk about them in terms of the COVID related supply chains being gummed up. There were weather related shocks, and there were energy related shocks with pipeline disruptions and things like that. All of these shocks feed very directly into commodity prices, whether they talk about weather disruptions on agricultural produce that feeds into food prices, or the pipeline shocks that feed into higher gasoline prices, which feed into your CPI basket. So commodities were uniquely placed in terms of hedging against these kinds of shocks, and did far better than most of the asset classes. Going into 2022, can it continue to do this? Well, yes, I think so, because although central banks have started to think about raising interest rates or significantly reducing bond purchases to remove all the monetary stimulus that was in play over the last few years, just really tends to affect the demand side of the equation that drives inflation. The supply side disruptions could remain, and we believe that commodities will continue to play that unique role in hedging against those supply side shocks. So 2022 could be also a good year for commodities as an inflation hedge.
Great. I just want to pick up quickly before we move on gold there and rates. You were talking there about central banks, because raising rates is historically bad for gold in terms of the performance of gold and its price. But considering that inflation is likely to remain elevated in the next few months, or at least years potentially, real rates are also going to stay low for a while. So is this a reason to be bullish on gold?
You're right. Rising rate environment tends to be bad for gold, but if inflation remains high enough, that should counter it, keeping real rates low. Gold does respond to real rates historically. 2021, once again, was that anomaly. It didn't quite do what it was supposed to do. So if gold starts to go back to its normal behavioral traits, then 2022 should be good for gold. In the first few weeks of this year, we have started to see gold maintain a bit more resilience. Despite, the raising rate environment, gold has held up pretty well, apart from, yesterday with the Fed's, FOMC meeting, providing that slightly more hawkish tilt that's taken gold off a little bit. But apart from that, in the first few weeks of 2022, gold seems to be behaving a little bit more like it should do, and recognizing the elevated inflation reality that we're living in.
Okay, so I want to talk about oil now because it's probably been the best performing commodity in January. I mean, it's been a pretty impressive rally that we've seen in oil prices in the first few weeks of this new year. How do you see oil prices evolving in the next few weeks, months, in the kind of immediate future? How do you see oil prices performing?
Let's put a little bit of context behind what's on in the oil markets. 2020 was bad year for oil because of the COVID pandemic unfolding, and at the same time, OPEC at that point engaged in a price war amongst OPEC members and non-OPEC members, engaged in a price war primarily between Saudi Arabia and Russia. But realizing their mistake, they by the sort of April of 2020 made a deal to tighten production quite significantly. So in 2021, we saw OPEC continue to be very tight in oil production, raising it only by small amounts as conditions started to improve, keeping a structural supply deficit in the oil markets for most of 2021. But that process of unwinding that supply constraint is continuing. And we believe that this year we could end up in an oil market surplus because demand conditions, while they're improving, supply will continue to rise more than the demand conditions are improving. It's not just OPEC that is increasing its supply, non OPEC countries are also increasing supply. So if everything goes according to plan, we should end up in a little bit of a surplus, not a massive surplus, just a little bit overbalanced, which should possibly cap the upside to oil prices. And we are very close to $90 a barrel on Brent right now. So, it means that the upside to that could be capped. But there are risks. And the chief risk right now is geopolitical, with an escalating situation in Russia and Ukraine. There's lots of fears around whether sanctions could be implemented, not necessarily on the oil market. Most people rule that out, given that it's strategically too important both for Russia and for Europe to implement any sanctions on oil or natural gas directly. But sanctions applied elsewhere could disrupt the flow of oil. For example, if financial transactions become more difficult to do, or if other ports in a means of exporting become hampered. There is that geopolitical risk, and it's not just the security situation in Russia and Ukraine. There have been missile strikes in UAE or in Saudi Arabia that have been narrowly averted in terms of seeing disruptions to the pipelines. But I think it's far more in the market consciousness that these sort of risks exist to supply disruption. So I won't rule out short-term shock price movements up, but on the whole, if everything goes to plan, we could be in a well-supplied market.
I think another exciting area in 2021 has been soft commodities. They've, posted a significant price rally in last year. We saw that in lumber prices, cotton, coffee. Looking ahead, if we see a drop in future prices in these commodities, then potentially we can see some pent up consumer hedging coming in. I know with these elevated prices that we've seen, potentially we've seen this hedging purposes slightly restricted. You know, 2022, we are starting the year with low stocks, and especially I think in agricultural commodities. This can, I guess, lead to heightened volatility as we head into new year and as prices stabilize. What are your views on the performance of these commodities, and what is your outlook for these, especially agricultural commodities?
Yeah, so agricultural commodities, as you say, performed spectacularly well in 2021. It's posted, multi-decade highs in terms of performance. And once again, emphasizes that point about having a broad commodity exposure, providing that kind of inflation hedging qualities. Food prices are a big part of the consumer basket. And when agricultural prices rise, having that knock-on impact on food prices is very worthwhile having those hedges in place. So, what had driven these price increases were multiple weather disruptions. We are currently in a La Nina weather pattern, which involves a cooling of various parts of the world, impacting the trade winds and having an adverse weather impact reducing the yields of various crops. So, cotton, as you mentioned, the cotton crop in the US has been sort of hampered by the phenomenon. Soybeans have also been performing really well, and the soybean complex, given that a lot of soybeans feed into soybean oil, which is also used as a biofuel, has done really well. Given the oil market behavior, anything that's related to fuel, including soybean oil in its biofuel applications, have also done extremely well. On the flip side, you've had some weaknesses. For example, wheat yields have been quite strong, actually, and therefore wheat prices have underperformed, at least in the last month or so. While some of the weather stresses in South America have been quite good for some of the soft commodities, with wheat, given that its harvest has been largely completed before the weather disruptions came into play, it wasn't able to share in that rally. Looking forward to 2022, it's always hard to forecast weather over a longer period of time, with weather being a key factor driving agricultural yields. It's hard to provide a huge amount of visibility. But what we can say is that the La Nina weather phenomenon is likely to die out in the coming months, so that won't provide the same upward price pressure. But what we are seeing is the frequency of weather disruptions increasing, and that seems to be tied with global warming weather patterns. So, despite the fact that we went through a La Nina that provided a little bit of cooling, on the whole, outside of these La Nina or El Nino weather patterns, the general trend is for more heat stress. So, that could potentially continue to tighten agricultural production, but that could be a multi-year phenomenon as that climate change issue isn't really going away.
Okay, so and what about industrial metals? Is there anything there that stands out to you, especially in this new year, the first month of the new year? Is there any specific commodity that stands out in that group?
Yeah, so I think base metals, industrial metals in general, are performing strongly as they had done in 2021. But, the opening month of this year has been particularly strong. Nickel, for example, has moved to multi-decade highs, and that's largely linked to the fact that it's such a key metal in the energy transition. So let me just explain what I mean by that. We have an energy transition going on where we're moving progressively to consuming more renewable types of energy sources and using technologies that reduce our reliance on hydrocarbons being oil, coal, natural gas, for example. Combusting hydrocarbons at the point of use provides some of the largest sources of greenhouse gas emissions in the world. And, for example, through the uses of cars and trucks, there's a huge push to move away from internal combustion engine vehicles to be able to meet the net zero commitments made by various governments around the world. With that in mind, battery electric vehicles are likely to be in greater demand. Now, nickel is a key ingredient for the cathode active material for batteries. And we know there's a lot of tightness in that market. So while nickel in aggregate may be in fairly balanced market, the nickel that's suitable for battery grade chemistry is very tight and is in a deficit. So we're eating up a lot of above ground inventory there. So if you look at the stocks of nickel, they've been coming down, and there's a lot of investor bullishness around the metal space, including nickel. But most of the industrial metals are in a state of what we call backwardation in the futures markets. Now, what we mean by backwardation is that the futures curve is downward sloping, indicating that investors are willing to pay more for delivery of a futures contract immediately than wait a few months and when the prices are lower. So people are less willing to lock into lower prices today for delivery in a few months' time, which indicates the slightly more urgency of getting hold of the material, which indicates that how tight the markets are. So there is a lot of strength being displayed in the industrial metals market. But as an investor, that's quite positive because you can harvest positive roll yields in a backwardation market. So as your futures price starts to approach the spot price, it's generally rising. So that provides an extra tailwind into industrial metal investment.
Great. And just to finish off, I want to, talk a little bit about the currency because we've seen, the Fed meeting this week and expectations about interest rates rising and we have seen the dollar strengthen and it's probably going to be one of the favored currencies in the next few months as we see this potentially quantitative tightening coming. So a strong recovery in the US could potentially hinder some of these commodities, especially the prices of commodities that are denominated in US dollars because they have this inverse relationship to the movements in the dollar. How much impact do you think this will have? Is it something to keep an eye out? Do you really think that these moves in the FX market, and especially in the dollar, are they going to be impacting these commodity prices in the next few months?
Yeah, I think you're right. The headwinds from a stronger dollar will be present, but on the whole, I think that the supply demand fundamentals for most of the commodity complex will be able to sort of withstand the dollar headwinds. I've already gone through the energy complex, that could be quite imbalanced. So that's probably a bit more susceptible to dollar appreciating headwinds. But when we think about the base metal space, which is very tight due to this energy transition, but also the increase in infrastructure spending is likely to take place this year. I think that, we could see industrial metals look very strong. Also with agriculture as well, so long as this tightness is maintained for the remainder of this year, it will likely to overcome the dollar tightness. But it does provide a bit of a headwind that is hard to evade.
Right. Well, thank you again, Nitesh. Thank you for joining IG's Trading the Market podcast and for all your wonderful insight on the commodity space. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.